great day, and appreciate you taking the time to jump on the call here today. We're going to have a really good it's being put together by Chris Santee and Richard Brown at Patriot Capital Corp. Chris Santee is the owner of Patriot Capital, and Richard Brown, the VP of Marketing. We want to talk a little bit about EMV, which is the change in how certain credit cards will be processed and the liability shift that's going to take place as a result of that. And Chris and Richard are going to explain a little bit about what EMV is, what the implications are of the liability shift. And then they're going to spend a little bit of time talking, too, about what opportunities may be present for some marketers to not just have to respond to it, but to actually use it as a competitive advantage in their businesses. So it should be a real good 45 minutes to an hour. Just a couple kind of lay of the land. I have everybody muted, all the listeners on the call. And the reason is to kind of keep background noise from feeding in. But if you do have a question, we would really enjoy addressing it. On your GoToWebinar, there should be to the right a little place for you to type in questions. Those questions will come to me, and then we can address those either during the course of the call or at the end. And then also just wanted to make you aware that we are going to record this webinar, so if you are interested in what you hear, you can view it again at a later date or share that rebroadcast with somebody else in your company who may find it useful as well. So on that introduction, let me go ahead and turn the floor over to Chris Santee, to you, and allow you to tell us a little bit more about EMV and the implication it's going to have for us as marketers and how we might be able to gain competitive advantage from it. So, Chris, are you there? Or Richard?
Yeah, I'm here, Jed.
Okay, great, Richard. I can hear you. I think I lost Chris somewhere in this process. Richard, are we viewing your screen or are we viewing Chris Santee's screen right now?
We're viewing Chris's.
Okay.
If you want to, I guess if you want to give me control until we get Chris back, I can get us started.
All right, I'll go ahead and do that. Shift the control over to you. Thanks for holding with us here until we can get Chris back on the line, guys. All right, Richard, you should have control now.
Okay. Okay, we're working. Good afternoon, everybody. Thank you for joining us this afternoon. Just a couple of housekeeping items. The materials we're going to review today are proprietary and based on our best understanding of the situation. Given EMV involves a lot of different parties, we recommend that you talk to your payment processors and your accountants prior to implementing any strategies.
Hey, Richard, can you hear me?
Yes, Chris.
I'm so sorry, guys. I have no idea what happened. It just stopped working. But you can hear me now?
We can hear you, Chris, yeah.
Okay. I'm sorry. Finish this screen, and I'll pick up on the next one, Richard. I'm sorry to interrupt. Had a little technology glitch there.
Okay. So there's two items, as Jed said, we want to cover today. Firstly is how is the landscape shifting both in capital markets and in regulations, and what does EMV mean? And then secondly, how can you use this then to create some competitive advantages for your business?
Briefly, this is Chris Santee, and I'll pick up here, Richard. So briefly, a little bit about the capital markets overview. Over here at Patriot Capital, we've seen some really tremendous changes in the capital markets since the Great Recession. So obviously, as everyone knows, capital was very free-flowing and very easy to access from the early 2000s up through late 2007, arguably middle of 2008. But things really took a big change for the worse that even impacted, I'd say, good and excellent borrowers up through 2009. And I would say that we saw that impact through 2009, well into 2010, and even to the first part of 2011. What I can tell you that we're seeing today is we're seeing an exceedingly frothy capital market again. Good deals, middle-of-the-road deals, even lesser deals have a home and have a way to get done these days. The reason this is important to understand is that the types of credits that are in the petroleum industry vary widely, from a single-site operator who's maybe somewhat new to the industry to multi-generational family businesses and publicly traded companies. Most of those borrowers, or many of those borrowers on the smaller scale, really had challenges accessing the markets up to about a year and a half or 2 years ago when things started to loosen up. Today, we're in an environment where I would say it's about as good as it gets. Rates are exceedingly low. Credit is very flexible, and the ability to get transactions small and large done is as good as it's been since kind of the go-go days of right before the Great Recession. What that means is that there's a wide array of financial tools and financial instruments available for jobbers, marketers, and for their dealers. And what's important to focus on as we go into EMV is that you want to identify what are the appropriate tools for you. Your lines of credit, term debt, senior debt, equipment financing all play a role in properly aligning your capital stack so that you can best address what could be a significant spend for your customers or for some of you who are on the phone. Another part to consider is Section 179 and bonus depreciation was brought back at the very end of 2014. It allowed for acquisitions of up to $2 million in capital equipment in the calendar year of 2014. The first $500,000 was 100% tax deductible in that tax year, and the remaining up to $2 million was 50% tax deductible. So obviously, some very significant tax benefits were available if you acquired equipment. With a Republican Congress and a Republican Senate, although there's certainly no promises, we believe and we are hearing that Section 179 and bonus depreciation will again exist in 2015. And that should be very good news for many of you on the phone. A lot of the study group members have very big businesses. A lot of those businesses can benefit from additional tax write-offs. And Section 179, we believe, should make it back this year for very significant write-offs as it pertains to capital equipment. The important thing about that is that you want to plan how you spend and when you spend to take advantage of the tax benefits that are offered on a year-by-year basis. So when you're looking at the capital investment that something like EMV may require, you want to take a few things into consideration. You know, banks have lending, have pricing these days that is exceedingly cheap, probably as low as any of us have seen. But with those very low rates come some requirements, collateral requirements such as first position on some of your properties, accounts receivables. There might be some covenants such as debt to equity or liquidity ratios. There might be some control that the bank exerts on you in terms of no further borrowing, or you have to come to them before you can use lenders outside of your senior lender. But with all of that comes great rates. On the other end of the seesaw here is equipment finance companies and alternative forms of capital, such as Patriot Capital, where you're going to have a higher cost of capital, maybe a couple hundred basis points higher than what you're getting at a traditional lender, but it's going to require virtually no collateral other than the equipment, 100% financing, no control, no control meaning we don't ask for control. You have full control of your business. No covenants, no debt to equity ratios, no liquidity ratios, no annual reporting. Simply equipment financing using just the equipment as collateral. When you're going into a capital spend, such as EMV, understanding that there's useful sources out there that can help you with that is something that might be valuable to the members on the phone. Go ahead, Richard.
Good afternoon, everybody. So let's jump into EMV and what it means. Just at a high level, EMV is a group that was originally formed by EuroPay, which is the leading credit card in Europe, MasterCard and Visa in 1994, and hence the acronym EMV for EuroPay, MasterCard, and Visa. It is now a standalone company that was formed in 1998 and includes JCB Bank and American Express as well. As you can see in the graph, it has become the global payment standard. So in Western Europe, 96% of transactions are done via EMV. In Canada and South America and Mexico, it's 96%. Eastern Europe, 50%, and Africa, 76%. So outside of the U.S., EMV is rapidly becoming the way payment is done. The reason for that is it provides a much greater level of security than the magstripe cards we're all used to. Magstripe cards are primarily what is called single-factor authentication, which means it just uses the magstripe data. In gas pumps, a lot of you may be using now multi-factor, which requires the zip code as well as the magstripe data. But as you know, that's not highly secure. So what EMV chip cards do is employ unique data in each transaction. You've probably all seen a chip card by now, and the purpose of that chip is to generate a unique number for each transaction, which makes counterfeit cards much harder to generate, and any other type of fraud a lot harder to pull off. So as the cards are rolled out, what we're faced with is what's called a liability shift. So it's important to understand from the card brands, this is not a mandate, but it is what they call a liability shift, meaning that the party that causes a contact chip transaction to not occur is liable for any of the resulting fraud and data breaches. Beyond that, though, some of your brands may have a mandate in place and will or may announce that you need to be EMV compliant and be able to take a chip and pin transaction inside and outside by a certain date for their network. The main scenario that we need to be concerned about is the second scenario in the middle of the slide, which is when someone comes into your location with a chip card and you process it at a magstripe terminal, at a current terminal. In that case, you are generally liable because the issuer has put out the chip and pin card and you have chosen not to have the technology to accept it. So if it's a chip card at a chip terminal, you're not liable. If it's a magstripe card at a mag terminal, you're not liable. But once the chip cards are out there, you will be liable if your hardware is not updated.
So the two key dates
in terms of the dates,
October 1st, 15, and then October 1st, 17. And we're going to see two different shifts that take place for in-store transactions and then out-of-store transactions.
Right, thank you, Jed. The dates are shown on the screen now. And again, I would suggest consulting with your brands to see what network shift dates they're putting in place and what plans and when you need to file them. So several of the brands have announced that to qualify for incentive money, you need to declare your plans and have a plan in place in Q2 through May and June. You need to show proof that you're moving on the in-store side of the equation. So we're within 90 and 120 days of the brands wanting to understand what you're doing. So I think that's important. I think the other thing to think about is going back to this graph of the world. Once inside the U.S. is done, so that includes Target, Home Depot, Chipotle, and Chick-fil-A, everywhere that takes inside payment, including C-stores, then really the last place for the crooks to go from around the world is going to be on the forecourt. So I'd encourage you, as you think about your plans, think about maybe moving earlier to protect your brand, because if there is a breach, it will impact your brand and potentially your pocketbook. So in terms of what's needed by some of the different hardware platforms, on point of sale, most Ruby or Verifone systems will require the addition of a commander box, which will allow you to upgrade your hardware. In the case of Gilbarco's Passport, most situations will require a software upgrade, which can be remote, and a pin pad. Then as we look at dispensers in 2017, for the Encore 700S line, they will be shipping in Q2. Product that's EMV ready, or it's already EMV ready now in Q2, should be fully enabled. Encore S 500 and 300 and Advantages, as well as Vistas and Ovations and Toka Premiers, can all use retrofit kits from Gilbarco. On the Wayne side, the Ovation IX, Crind is ready. Will need a slight upgrade, and then Vistas and the original Ovations can be upgraded with a Crind retrofit kit. And again, I would get with your PEI distributor and talk to them about your specific equipment and situation. Also, as you think about this and the amount of equipment that needs to be upgraded over the next 3 years, there will be a shortage of technicians. So we anticipate through the summer and fall of 2015, and then through most of 2016 and all of 2017, technicians will be hard to find, and if you don't have a plan and an agreed plan with your service provider, you may look at either overtime situations or premiums, or not being able to get a technician at all, because the workload is going to be somewhere between 4 and 6 times the normal workload in the industry for technicians. So as we think about that, there's 2 ways to think about EMV. One is the glass is half full. It is going to be a large expense for the industry. It does address our security issues around card fraud, but there's also some other ways to think about how to create opportunity from this and make the glass half full. I would encourage you, if you haven't and you get the opportunity, Michael Davis from NACS has a very good presentation that deals with what consumers want from C-stores and a lot of the NACS research that they've conducted over the last couple of years on where he sees the opportunities. And many of those opportunities are going to be enabled by some of the new technologies that are out there.
Richard, before you jump into some of the opportunities just on the EMV front, do you have a feel for the percentage of cards out there presently that are chip and pin ready versus presently mag stripe or mag strip, I should say, and let's say 12 to 18 months from now, what that percentage of cards may be?
Yeah, I believe, Jed, the percentage that will be chip and pin by October is targeted to be over 50% of all cards. And the reason for that is if the issuers have not issued chip and pin cards, then they hold the liability. So if someone comes into your site with a straight mag stripe card, the card issuer has the liability. If someone comes in with a chip and pin and you cannot accept it, then you have the liability. So you are seeing all the card companies are issuing new cards as quickly as they can and trying to get everybody to chip and pin.
Yeah, so by October it could be over 50% of cards, and even though it may be a relatively small percentage today.
Yes, they're going full bore on an upgrade, and I would expect to see by the middle of next year, well over 75% of your transactions inside the store will be chip and pin.
Because as a marketer, then I got to kind of ask myself, wait, what's my probability of exposure? And if 50 to 75% of transactions, going through my systems are potentially I'm liable for because they're being made with chip and pin cards, that's the more compelling reason, I guess, to potentially make upgrades than if it's only 5 to 10% of the cards out there that potentially could have liability toward me.
Yeah, that, and as the universe contracts, so now everybody's taking magstripe payment. Come October, a lot of the big retailers will have shifted to chip and pin. The restaurants will have shifted, and let's just say half of your competitors have shifted, if not 75%. So word gets out that you haven't upgraded, the odds of you being a target are much greater.
Yeah, you start to stand out as a sore thumb, so to speak.
Yep, and that's both on the inside, and then as we get into 2016 and 17 on the pump side as well. Thank you. Good question. So if we go back to how do we make the most of this situation and the expense, I would encourage you to think about a couple of things. One is, how do we improve the customer experience? So the technologies that have come out over the last 5 to 10 years, which include mobile wallet, some of the upselling technologies both at the pump and inside the store, like the Lift and Impulse products, and media at the pump, lottery at the pump. All those technologies can make the customer experience more enjoyable at your site and also help you expand both your revenue and customer loyalty. Second thing I would think about as you look at a technology plan is how do you improve your site operations using and leveraging connectivity, what's commonly called the Internet of Things, but all of the devices on your site are getting smarter. How do you use those to help you control both fraud and also maintenance costs? And then thirdly, and what Chris will talk about in a moment, is there a way to use this to help your dealers if you're a jobber, or if you're a jobber partner with your, if you're a dealer partner with your jobber, to extend your supply agreements and make it more affordable for everyone. Part of what we're looking at is a fairly large capital commitment. So, for example, if someone that has 50 dealers in their network, one point of sale at about $11,000 and 4 dispensers at $13,000 give you an exposure of $63,000, or for a network of 50 dealers, over $3 million of expense. So what we're looking at across the industry is one of the largest investments in recent times, probably since pay at the pump. And what we'd like to talk to you about is how you can use this to your advantage. One area that we've looked at is the difference in tax rates between a dealer and a marketer or jobber. So, for example, on a point-of-sale system, if a new system costs you $11,000, regardless of what class of trade you are, there's a significant difference in tax rates. Dealers, in a lot of cases, are paying tax at a 10% or 15% rate, whereas a marketer is paying taxes anywhere at 33 to 39%, and then also state taxes on top of that. So we take the depreciation on that $11,000 investment. We have a difference in depreciation of about $2,600 between the $3,700 that a marketer could recoup at 33% and $1,100 that a dealer could recoup at 10%. So for someone with 100 sites in their network that they supply or partner with, that could be $262,000 or $250,000 just on point of sale. And there are ways that we can work in partnership with your dealers to enable them to complete these upgrades, and also for you to extend supply contracts. So if we go back and revisit the slide Chris mentioned and went through at the start of the presentation, dealer programs can give you the opportunity to deliver some growth as we work through EMV. So I'd like to hand it back to Chris now to talk about dealer financing and how that provides an opportunity for us all during this upgrade cycle.
Thank you, Richard. So we've been focusing a lot on how to help marketers identify the proper ways and the proper opportunities to both increase their supply network, to expand and renew supply contracts, and to possibly use the EMV liability switch and the amount of capital that it might take for dealers and jobbers to adhere to it. How can we look at that as an opportunity to get your dealers to extend, renew, or to grow your supply business? There's really 7 strategic benefits of dealer financing. So the first one is, as Richard had mentioned, we look at dealer credits all day. We have about 3,800 locations with single-site operators that we've financed over the last, that's on our portfolio of loans that we've financed. So when we look at dealer credits, to Richard's point earlier, oftentimes they've been in business for several years. They have some excellent personal credit. They might have some great cars on their credit bureau report and a nice home that they own. But traditionally, the taxable income that will show, because of the cash nature of the business, might be $30,000, $40,000, $50,000. Now, certainly there's some that show very significant taxable income, and there's certainly some who show nominal taxable income. But from what we see, we're seeing a lot of 5-figure income, $35,000 to $60,000 annual income. So the tax benefit, or excuse me, the taxable income is low, and the tax rates they pay are also very low. So when you look at your ability to acquire equipment on behalf of your dealer base, you might have a built-in benefit of 20% of the value of that equipment if you depreciate it versus the value of that equipment to your dealer. And that gives you an opportunity to add or extend that supply contract. It gives you the ability to maximize your tax savings. It also gives you the ability to increase your dealer retention through the asset control. In other words, by putting that equipment at that dealer site, not only does it give you the opportunity to extend that contract, but if 7 years into a 10-year supply contract, a dealer decided to go with a competitor, you might have some additional reasons that he wants to stay with you, such as the equipment that you've invested in and the equipment that you own that's located at his site. I hear from a lot of jobbers and their territory reps about the difficulties that came with PCI compliance from about 5 years ago, and what they had to do to chase down their dealers to get them to comply with PCI a location at a time. We think that this time around, a lot of forward-thinking jobbers will say, you know what, let me use my better cost of capital, let me use my better tax benefit, and let me use some of the rebates and benefits I get from my majors. Let me grab a hold of everything that needs to get done, or a good majority of what needs to get done, so I can ensure that it's under compliance and can ensure that I'm meeting my major oil company standards. It allows you to shift the discussion from price to value provided. As you're out there building your supply contracts, you're building in pennies on rack, or what kind of rebates, or what kind of upfront cash. There may be additional ways that you can help your dealer, such as talking more about bringing him up to compliance, and in return for your help with that, they would go ahead and renew or extend their supply contracts. Properly documenting and controlling the equipment. We look at a lot of jobbers out there who might write it into their supply contract, but are they properly filing UCCs? You want to think hard about, are you putting fixture filings on the sites to ensure that if there was a sale of that site, that you were informed or that you were paid out before that sale occurred. And you want to also have the opportunity to pass on a competitive cost of capital. So you might pass on your much cheaper cost of capital to your dealers, or you might control the financing of that equipment, and you might turn it into a profit center. In other words, if you're borrowing in the middle single digits on a fixed rate, and your dealer would traditionally borrow in the high single or low double digits, there might be 500 or 600 basis points of premium between what a dealer will pay for capital and what a marketer will pay. Well, in there's an opportunity for you to do better and to help them do better. So perhaps you're borrowing at 5.5 and in turn passing on an interest rate to your dealer at 7.5. He's still getting much better pricing than he would get on the street, and you're helping him get compliant. When we look at it, and when we talk to marketers about how they look at their dealer base, we really hear almost the same thing from a wide variety of customers. I've got my guys who I would jump through fire hoops for. I've got my guys who I'm happy to supply, but that's about all I can do for them. And then I have a lot of customers who are in between. So we've kind of broke that out to regular, plus, and premium. So for your regular customers, you're happy to help them understand EMV. You want to make it easy for them to get the capital that they need. You might want to refer them to a company such as Patriot so that we can help finance the acquisition costs for them. With customers that require a little bit more, maybe they need a $75,000 investment, but maybe they only pump 50 or 60,000 gallons a month, and what it would take for you to justify a $75,000 investment is just way too significant in terms of upgrading all their equipment. But what you can think about is what can you do to help them get compliant without having to take on the expense all on your own. Some of those ideas include things such as rate buy-downs. We had a customer about 2 weeks ago who came to us. His dealer needed $100,000 for pumps and POS. The volume did not justify that kind of investment, and the dealer was not willing to re-up for an additional 10 years to make it cost-effective for the marketer. So what the marketer did is the marketer came to us and said, hey, I want to do something for this customer because he's valuable to me, but I don't know how to make it most appealing to him. So what this marketer did was he paid us a rate subsidy up front of several $1,000s, and we gave the dealer 0% interest financing for 5 years. So for instance, on this $100,000 investment, the jobber knew exactly what it cost him up front. It was, I think, about $8,000. And by making that investment, the dealer got very low rate financing on a fixed rate term and was able to enter into a portion of an extended supply contract with a very nominal investment from that jobber. Now there's also the customers who you'll do anything for. They're great customers. They've been with you. They have fantastic volume. What you might consider is you might consider looking at those folks and handling the financing of all that equipment for them. You might have helped them acquire the equipment through the distributors of your choice. You might help them negotiate the best terms. You might provide your own capital or finance the equipment through a company like Patriot Capital so that you can extend that supply contract and then work your payback over time through the renewal of your contract or the extension of that supply contract. It gives you additional control. It addresses the level of partnership that your very best customers justify, and it will go ahead and help you renew as many of those customers as possible. The point of this slide is that when you're looking at your wholesale network, you want to make sure that you're helping each one of those customers in whatever way you can and whatever makes good business sense for you, and it's not an all or nothing proposition. It's not either you finance the equipment or you let him figure it out. There's a whole lot of in between. And what I want to make sure that we cover with you all today is that the flexibility of the capital markets today and the cost of capital being as low as it is, there's a built-in benefit for a proactive jobber to be creative in the ways that he can help make EMV work for them. Here's a little bit of a comparison on interest rates so that you can just see what it means on the street to a dealer. So if a dealer and a jobber are both looking at a $63,000 deal, and you have installation, taxes, et cetera, of an additional $17,000 for a total cost of $80,000, the difference in monthly payments could be approximately $140 per month per site. So that savings over 5 years is $7,800 if the marketer were to acquire the equipment and finance the equipment on behalf of that dealer. Now, what can you include in a program? Many folks that we're talking to are saying, when I do my EMV, I'm also going to do some imaging. When I do my EMV, I might do some tank work. When we put in new dispensers, we might consider some light upgrades. It's important to note that you can build programs for your network that can include everything from card reader upgrades, simply the retrofit card readers. Those are financeable. POS systems, image upgrades and graphics package. I'm talking about canopy wraps and price signs, LED lights, car washes, and EMV-ready car wash entry systems, canopies, UST upgrades, inside the store equipment such as beer caves, coolers, freezers, virtually anything at mention. I think this is something that is worth thinking about when it comes to your network. Once retail and inside the store is handled at the big box retailers, at the small shops, and in the convenience store network, there's really only a few places for the bad guys to look. If you think about what is an unmanned credit card accepting device, there's vending machines, there's some pay parking meters that accept credit cards, and there's gas pumps. And if you consider the volume of transactions that go through gas pumps compared to all the other outside unmanned credit card readers, gas pump is by far the one that has the most opportunity for the bad guys to focus on in an effort to steal data. Capital markets have operated differently since 2009. It's a good time to be a borrower. You all know that. Rates are exceedingly low. A point of consideration would be fixed rates versus variable rates. If you believe that we are at the lower part of the rate market and that in the next few to several years rates will rise, it might make sense to put equipment financing into play on fixed rates today, and you might be able to look back in a few years and that could be a very, very savvy decision. With all the things that a marketer has to balance, volume turmoil, cost of capital, the challenges with margin, fuel volumes, the last thing you want to need to measure is a variable rate loan tied to equipment that you place at a dealer location. As those interest rates rise, that could really eat away your profitability. Fixed rates is certainly worth a consideration, even if it costs a little bit more. Jobbers may have significant tax advantages and lower cost of financing than dealers. We know that that's true. We know that in a wide sampling of customers, jobbers almost always have a much larger tax liability and can benefit much greater from the depreciation than can a dealer. This creates an opportunity that can be mutually beneficial for both of those parties. The EMV rollout is going to require significant capital investment. How far you participate with your dealers is up to you. What we want to make sure that you start considering is that over the next 3 years, going from the inside the store liability switch in October of 2015 to the forecourt in October of 2017, plan your strategy to maximize your tax benefit over the next 3 years and to consider the proper ways to finance the acquisition of that equipment over that period of time so it makes sense for your business and you can take advantage of some of the tax opportunities that are coming our way, hopefully, with a Republican Congress and Senate. Equipment financing is a tool that leaves other assets free and clear and does not use your available cash. Another part that we believe we're going to see is we might see some jobbers, and certainly we'll see some dealers throw up their hands and say that is about enough for me. That's going to be some buying opportunities. And in those buying opportunities is going to require cash and is going to require senior lenders. Make sure to consider that before you use your senior lenders or your cash for a large equipment investment. We've been doing this for 15 years and are thrilled to be recognized by the PMAA as the best in the industry. We have worked with study groups as a below-the-line club member for the last several years, and we're very pleased to help any of you or help your dealers put together the capital they need to help grow your business.
Thanks, Chris. One question that kind of came to my mind as we're going through this is, the industry went through PCI compliance, a few years ago, and now EMV is the next major, kind of capital expenditure that'll be placed on firms. How much more secure is EMV ultimately going to be, preventing theft and fraud and so forth? Do we have good expectations on that, or is it marginally more secure?
Richard, we have talked about that, and we've got some soft statistics about changes between what you see in Europe and what you see in the United States today. Richard, can you recall some of those numbers?
So the last study I saw was a study in the UK that once they went to EMV, card fraud dropped by over half, and a lot of the remaining fraud was actually based on U.S. Issued cards or fraudulent cards that had U.S. addresses because they were still mag stripe. So obviously it's been a huge investment around the world, and the fraud rates have dropped significantly in both Western Europe and Canada and South America.
Mm-hmm. Interesting. And one of my big takeaways from this call here was EMV, it's not mandatory for any retailer or marketer to adopt it, but should you not adopt it, that liability in certain cases will shift onto you and away from the banks, which is an important thing for everybody to consider as they plan the business. And I was just thinking about a lot of these either dealers that are out there, and you mentioned this in your summary, Chris. The industry's competitive, and not everybody's profitable. Do you have expectations for this additional capital expenditure and the kind of pressure it may put on some who just choose not to adopt it, and then therefore, to your point, are potentially acquisition targets?
Jed, I think that there's going to be some folks who just don't get compliant and are accepting of the liability risk. And you know what, frankly, for some low-volume sites, I think that's a perfectly prudent step. If you're a very low-volume site and a smaller operator and the liability is not of a great concern to you, then I think that it's hard to justify a $100,000 or $150,000 investment for pumps and POS systems. For the larger, the problem is going to be, or what you need to pay attention to is, what are the major oils going to say in terms of what they expect from marketers and from those dealers? So that's going to be one point that you need to focus on. And then another one is going to be, to the major oils point, if a small, I'll just say shell station, if a small shell station So certainly, I think it's so important to say it's not a mandate. It's not something that you have to do. You need to weigh the liability risks. You need to weigh what that means to your business if you're a private branded operator. And if you're a major oil brand, what is it that your brand is stating as their expectations in terms of your EMV compliance.
I think one other thing that we saw in Canada was some of the retailers messaging once they had their networks upgraded that they had secure or more secure payment at the pump than the market in general had. And so I think you will see in 2016 some of the early movers in the U.S. starting to message that as well, that you know, your transaction is safer at under their brand than maybe somewhere else.
Mm-hmm. And guys, one question that came from the audience was just, you know, approximately what percentage of credit cards are chip and PIN now? My understanding is that number is between about 5 and 10% presently. You can weigh in. I've just kind of heard that third hand, but what I heard you guys say was it was going anticipated to over 50 to 75%. Is my understanding correct on that?
Yeah, that's true, Jed. I think at the start of the year it was in that 5% range, and I believe the number of cards being shipped before October is 400 million. I heard that number in one conversation.
And then in terms of credit card processing fees, are there going to be any differences, say like lower processing fees on chip and PIN cards, or any kind of pseudo incentives like that through the processing companies?
I haven't heard any discussion on the interchange fees being changed. There is some talk of some of the brands offering incentives to help with the point of sale upgrade through the summer, but in terms of the interchange fees, I haven't heard anything yet. But you know that if fraud goes down, you would logically assume that that some of that should be passed into the marketplace.
Mm-hmm. And then as that October 1st deadline draws nearer, are there any benefits to waiting to make upgrades as opposed to doing it now, or is it advisable to start as soon as you can? I remember you talking a little bit about technicians and availability would be pinched some later on, but you know, are there other benefits strategically to potentially delaying making upgrades?
I think the two, Jed, one is the technicians and the fact, you know, if you wait till the end, you may end up paying overtime if you can find somebody, because the industry historically moves towards moves closer to the deadline, is number one. And then number two is from a branding opportunity. People the awareness of EMV is growing very rapidly. There's TV ads from most of the banks on chip and PIN payment now. So as consumer awareness grows through the summer, I think you're going to see people starting to search out chip and PIN locations and be a little more wary of magstripe.
Mm-hmm. Another question from the audience is, how can we determine if the hardware/PIN pads we currently have are EMV compliant?
I think the best thing there is to work with your PEI distributor and do an audit across your network of what you have. And there are a couple of PIN pads that are approved, and and understand what those model numbers are, and either do an audit or have your equipment distributor do that audit to confirm you have what you need. And then also a timeline on putting in the software that you'll need to handle the EMV transaction. And then one other thing actually to be aware of is be sure you've got good data speeds at your sites, because the amount of information that is transmitted in an EMV transaction is significantly more than in a magstripe because of the dynamic encryption of the card data. So as you're putting out your technology plan, make sure you understand what your data speed needs are, and that your site can handle that.
And we have the kind of chip and PIN, and we've got chip and signature as well. Are there differences between the two that we need to care about?
I think the main thing is to be aware of what your processor requires, and there's ongoing discussion now of whether chip and signature or chip and PIN will be the dominant form here. In Europe and Canada, it is chip and PIN, which is more secure because, as you know, chip and signature, the validation on the signature is pretty weak. But there is momentum for chip and signature in the U.S. and understanding the differences in your liability exposure with your particular bank and processor, I think is critical to your deployment strategy.
Mm-hmm. And a big takeaway for me, which I heard you guys say, was additional capital expenditures will be required for those who choose to upgrade, and especially for folks who have a dealer base out there, and there can be opportunities with those dealers to take advantage of the situation, lock in longer supply contracts or other kind of hooks into them. For somebody who's just a retailer themselves, maybe they don't supply dealers, are there opportunities that could be taken advantage from EMV, or is it just the added security and avoiding the liability shift onto you?
I would think about the customer experience and some of the things we talked about there. So as you look at your equipment plan and your technology plan, think about it not just about meeting the EMV requirements, but what are you going to need over the next 5 years or 10 years, because most of this equipment has that type of life, to enhance customer experience and stay competitive. So whether it's Apple Pay or some other mobile wallets, media at the pump, media inside, upselling at the dispenser, or remote management of your site to improve your service, I would understand what equipment is available now and how that fits into both your marketing and operation plans, and look at a holistic plan rather than just an EMV compliance plan, because you don't want to come back in a couple of years to upgrade because you now want to implement the next customer-facing technology or operationally advantaged technology.
Mm-hmm. Jed, I would also comment that a strategy that we're hearing from a lot of retailers is at their better sites, they're looking to do a full upgrade for both the dispensers, the POS system. That might include something like Wayne's Innovation TV or Gil Barco's Applause TV, the media at the pump, and then they'll take their 7, 8, 9-year-old dispensers, retrofit them, and downstream them to some of their lower volume sites. I don't think that there's anything overly creative about that. I think jobbers have been doing that for years, but I do think that's a strategy that if you look at your entire store network as a retailer, not a wholesaler, you want to get your best equipment at your sites that do the most volume, and then possibly at some of your lower volume sites find a cheaper or easier way to meet the compliance.
Well, sounds good, guys. I really appreciate you sharing all this information. Are there any closing thoughts you guys have?
For additional, well, first off, Jed, I just want to tell you how much I appreciate the opportunity, and thank you to everyone on the phone for attending today. We really appreciate it. We've got reps across the country who are geographically located and able to consult with you further. They can help you come up with a strategy for your dealer base. They can help you work transactions at your office and meet with you in person. We've got a great group of folks. No rookies on the map here. We've got an office in San Francisco led by Jeff Smith. He's been with us for 13 years. Steve Morris out of Houston, Texas is a new office we've just opened up. Mike Borelli out of Tampa, Florida. Jason Raffensberger out of New Jersey, Lincoln, Chicago, and Darren Bryson handles the Midwest. These gentlemen are all tenured and experienced in putting together transactions both for marketers and for their dealers, and we are happy to entertain whatever approach is most appropriate for your business, from working directly with you to working in conjunction with your dealers. We've got financing tools available that meet the needs of both marketers and dealers, and we're very happy to have the time with BTL today and with the study group members. Here's Richard and I. Please feel free to give us a call or drop us an email. And thanks again, Jed. I really appreciate it.
All right.
Thanks,
thank
everybody.
you, guys. Appreciate you educating me on EMV and all the quagmire around it as well.
You got
All
it.
right.
Thanks
Thank you
very
all
much.
for being on the call, and wish you all a very good day. Goodbye.